Welcome to our second presentation of Bond Yields and Valuations, Chapter 9. And in this presentation, we'll discuss the yield spreads and the yield curves and what they have to say about the future of our economy. And then we'll take a look at an old friend, the discounted cash flow model, and how it pertains to bond price predictions and bond price valuations. So let's get started on slide 20 with yield spreads. Yield spreads are the differences in interest rates that exist among various sectors of the bond market. In general, normally, the shorter the maturity, the lower the rate. The longer the maturity, the higher the rate. And if you've ever shopped for a home loan, you will see this in action. The mortgage broker, the bank, the credit union representative will show you a 15-year loan with a lower rate than the 30-year loan. And this makes a lot of sense, and we'll discuss the reasons why in just a moment. And in general, the higher the rating of the bond, the lower the interest rate, and vice versa. And this makes sense. If you have a good credit score, you're going to get a better interest rate. If your credit score is not so good, well... Now, treasuries carry the lowest rate typically, with municipal bonds being next. And general obligation bonds typically carry lower interest rates than revenue bonds. And again, this makes sense because, as we discussed in the previous chapter, general obligation bonds are considered, safer than revenue bonds, although the savvy bond investors will tell you that they love to do their research on revenue bonds because they get paid more. And then corporate bonds have the highest the highest interest rates. Non-callable will typically pay less than callable bonds because non-callable being a desirable feature for bond investors. Excuse me. Okay. Here, as of April 2nd, are the yield spreads. Now, as we said in the commentary on the assignment, Fidelity is very, very savvy when it comes to marketing, and they have a wonderful bond department. If you are thinking about buying your own individual bonds, give them a look. I don't get any kickback or anything, but they have quotes on thousands, tens of thousands of bonds. And as we see on April 2nd, we see that interest rates are starting to creep up. And what do we know when interest rates go up? Bond prices go down, so bond investors are starting to get a little nervous. But as we've said, and we'll say again, higher interest rates are actually a good thing if you have a long-term perspective, because it means you're going to get paid more. And notice the treasuries still, though, on the long end, are not really paying that well. In fact, the yield curve has slightly inverted, and we'll discuss that in just a bit, where the 3-year is paying more than the 5-year or 10-year. In fact, they've actually since gone up since that. It's April 6th today, and they've actually gone up since April 2nd. Whereas we go down to corporate bonds, and they're actually paying some healthy, 5%. Notice that the 20-year is actually a little higher than the 30-year. There's something to be said about that in just a bit. But we're finally, in the case of the corporate world, those are triple B rated, so those are just above junk status. But still, single A is paying almost 5% for 30-year bonds. So we're starting to get back up to historical norms, which again is a good thing. Yes, I do think so. And then muni bonds are paying actually, they're in between treasuries and corporates is what we'd expect. Now, what we're going to do is discuss the yield spread. Often, investors will speak about the bond spreads as being tight or wide. A tight spread means the interest rates among the bonds they are evaluating are very close to one another. So, example, treasuries are paying 4.8, corporate bonds are paying 5.1. That's a difference of 0.3%. Now, wouldn't it be nice if the talking heads and pundits and self-proclaimed experts would just say 0.3% difference? No, they're going to say 30 basis points. Yeah, a basis point is basically 0.01%. So you'll hear people say 30 basis points or 100 basis points means 1%. Oh well, get used to it. A wide spread means there's a big difference between the bond interest rates. The treasuries are paying, say, 3.2, but corporate bonds are paying 8.2. That would be 500 basis points. Yes, indeed. For several years, bond yield spreads were very tight. During the turmoil of 2008-9, the yield spreads widened to levels not seen in decades. Why? Because of the flight to quality. People ran to the safety of the Treasury and dumped their corporate bonds, dumped their municipal bonds too, as you'll see in a couple of the ancillary presentations. And they haven't narrowed significantly over the past several years. So now just get used to that term basis point, right? It means 0.01%. So 30 basis points, 0.3%, 100 basis points, 1%, 500 basis points, 5%. The yield curve is a graph that represents the relationship between a bond's maturity and its yield at a given point in time. So this is used to make comparisons among types of bonds. Now we looked at the chart. We're now going to look at a graph, a curve that is widely watched by economists and investors alike and politicians. Normally, the yield curve is upward sloping, which means longer-term bonds have higher interest rates than shorter-term bonds. And we said that's the normal way things are. That's the way things make sense. But sometimes, not often, but sometimes the yield curve is downward sloping. We hear that people use the term an inverted yield curve. Shorter-term bonds and treasury bills sometimes have higher interest rates than longer-term bonds. And we saw just a tiny little inversion in the table just a few slides ago. That doesn't make sense, does it? Well, here we are, folks. This is normal. The magenta, I guess it is. Upward sloping yield curve, the normal yield curve. But this, it's like a burnt orange, burnt red. The downward sloping yield curve. This is unusual, and it's called the inverted yield curve. And doesn't the investment world stand up and take notice when this happens? And it's happening right now, as a matter of fact, early April 2022. Why do longer-term debt securities normally have higher interest rates than shorter-term debt securities? Well, there are three reasons that are commonly given. The shape of the yield curve reflects investors' expectations of future interest rates. Well, this makes sense. Yeah, this makes sense, yes. If they believe that interest rates are going to rise, then yes, they would go with the shorter term and not so much the longer term. But if they believe interest rates are going to fall, you would go with the longer term and not so much the shorter term. The maturity, liquidity preference. Investors tend to prefer the liquidity of short-term securities and therefore require a premium to invest in long-term securities. Well, this again makes sense. Yes, as we said, if you go with a 15-year loan for your mortgage, you're going to pay less than if you go with a 30-year loan, or a 20-year loan is in between. And that's just because there's more time for things to go wrong. So the shorter the time till maturity, the less interest rate you will require as an investor. And then the third major reason, proposed reason, and there's some validity for all three of these, is that the market for debt is segmented on the basis of maturity. Supply and demand within each segment determines the prevailing interest rate. Well, that's why we saw that table with the different maturity levels, right? People are looking for 5-year or 10-year or 20 or 30-year or 2-year. Each of these three theories makes sense. Each has merit. But how do we account for the times when the yield curve is inverted? What factors could cause an inverted yield curve to occur? And what can the yield curve tell us about the future of the economy? Let's explore. Since World War II, every time the yield curve has inverted, where short-term rates were higher than long-term rates, the economy has fallen into a recession. Now, there was one exception. In 1966, the yield curve inverted, but the economy didn't go into recession. It just barely touched 0% growth. So it almost went into recession, but then bounced back up again. The yield curve inverted in 2019 ever so slightly, causing renewed fears of an imminent recession. But then COVID took care of that, right? It strongly reversed to a normal curve when COVID hit and short-term interest rates were then dropped to zero or close to zero by the Federal Reserve Bank because of the COVID crisis. For about 2 years before the beginning of 2008, the yield curve was slightly inverted. It was not a deep inversion, but it was slightly inverted. So for 2 years, the bond market was predicting a recession for 2 years. But the stock market, for the most part, didn't believe him. Hey, the economy looks good. Everything's doing well. Well, what about that home loan debacle that's about to hit us? Nah, don't worry about it. It wasn't until fall of 2008 that the officials charged with tracking the economy acknowledged, oh yeah, we're in a recession. Not caused by the stock market, not caused by the bond market, caused by the mortgage, well, actually caused by part of the bond market, the mortgage-backed bonds that were tied to the real estate liar loans. It took over 2 years, but the bond ghouls were finally proven right. Now, you'll hear people call bond investors the bond ghouls. It's not meant to be a real nasty, it's more talked about in jest, but it's something to think about. Now, why would a bond investor be happy about a recession? Well, think about what happens in a recession. Stock market craters, oh well. Earnings drop like crazy. The Federal Reserve Bank then starts lowering interest rates, short-term interest rates, and the demand for long-term money falls, mortgages and the like, and long-term bonds. And what happens when interest rates fall? And what happens when interest rates fall? Right, bond prices go up. So I don't really like that. It's said in jest, folks. I really don't like the fact that bond investors are called bond ghouls. But it's true. Bond investors like it when interest rates go down, and when interest rates go down, bond prices go up, and that happens in a recession. But if they lose their job, I'm sure not too happy about that. Now, what's happening now? Just recently, the yield curve has inverted ever so slightly, as we'll see. Uh-oh, is a recession ahead? Well, we've got other things to worry about, right? We've got a war. We've got a war in Eastern Europe. Excuse me. We have supply chain problems that are still working themselves out, and maybe an end to globalization where the West sort of pushes back to the West and China does its own thing with whoever they can work with in Asia and Russia. Who knows what's going to happen to them? They'll try to find any port in a storm. So we're all going to be more poorer. That's for sure. Globalization, whatever you think about it, nothing's perfect, but it did help everyone around the world not everyone, but the general economy around the world. It helped. Now we're going to be all a little poorer. Some people are going to be a lot poorer. So is a recession ahead? We'll see. Slide 28. So here is the yield curve on October 21st, 2021. And notice that if you go back a year, this is 2 years from here, October 2019, the yield curve was slightly inverted. You see how short-term interest rates were higher than longer-term interest rates, and then longest-term interest rates were higher than the short-term. But this is called the inverted yield curve. And this was, of course, before COVID, right? Before the 2020 election. So there was quite a bit of talk about a recession coming during 2019, 2020. Many experts, though, were quick to point out that the yield curve could be inverted for quite some time before the economy actually fell into recession. Well, then COVID came along on the scene, and both ends of the yield curve collapsed. Right, the short-term interest rates, the Federal Reserve Bank knocked them back down again. We had a brutal bear market, a very quick recession. Ugh. And so that was 2019. Now let's take a look at now on slide number 29, and we see that here's the yield curve in 2021, 2020. You see that they, after COVID came along, they were normal again. But now here's the very weird yield curve in late March of 2022. It has started to invert. The 2-year, the 3-year, the 5-year are higher than the 10-year. Well, the 10-year since then has gone up. So it's very choppy what's going on. The 5-year Treasury here is higher than the 10-year Treasury. As mentioned, when the yield curve inverts, the investment world begins to worry about a coming recession. However, events at this particular time are unprecedented. Are we heading for a recession? I don't know. I kind of feel that yes, we're long overdue, but still, it's such a strange time. We could be entering World War III, and who knows what's going to happen. But keep a long-term perspective. Recessions come and recessions go. The Federal Reserve Bank is said they're going to raise their interest rates and draw down their balance sheet, which is another fancy way of saying they're going to raise interest rates. And that there's a saying, don't fight the Fed. And so when the Fed is tightening, that typically we have a recession. But it just, if we don't blow ourselves up, the economy's strong, actually. People are finding jobs. They call it the Great Resignation. I don't believe that. They're just finding new jobs and saying, I'm not going to take this job anymore. I want a better job. And that's a good sign for the next 3 to 5 years. In the next 1 or 2 years, who knows what's going to happen? Yikes. But I'm optimistic. Economically, politically, I'm terrified. Terrified what's going on. Authoritarianism, I've told you this already, all around the world is rearing its ugly head, including in the United States, where one of the two parties has become pretty much radicalized. Things that Mr. Reagan and Mr. Eisenhower and would wake up today would just be horrified at what the Republicans are doing. And that doesn't mean the Democrats are that much better. They have their own problems. Nobody's perfect, right? But it's scary. It's really scary. And Mr. Putin has done his best to destabilize our country, and in some ways he's succeeded. But that's politics. Go to your political science professor. Complain to them. Okay, so much for discussions of happy things. Let's talk more about bond valuation. Slide 30. Bonds are normally priced according to the present value of their future cash flows. The semi-annual interest payments are future cash flows, and then the repayment of the principal when the bond matures. Although other factors will always need to be considered, such as the creditworthiness of the bond issuer. If the issuer runs into trouble, the price of the outstanding bonds will fall because investors will be afraid of default and they'll sell their bonds. They don't care what price, get rid of them. So does this sound familiar? Present value of the future cash flows? Yes, it's the discounted cash flow model. Whereas when we worked with stocks, we used the present value of the dividend payments and the present value of the expected price of the stock. We are now using the present value of the interest payments and the principal repayment when the bond matures. Now, we really should be using semi-annual compounding because bonds pay interest normally every 6 months. But annual compounding is a whole lot easier to compute, and it gives you almost the exact same answer, a couple dollars off. Excuse me. Computations are easily done using the present value tables, and the spreadsheets make it even easier. So, of course, we're going to take a look at the present value tables for this chapter, and then you'll see that they're a little bit different, but almost the same. And then the spreadsheet that we've built that will allow you to do it. And what we're going to see is, because the interest payments are, promised, they're not guaranteed, but they're, most people pay their mortgage payments, pay their car payments, and most corporations and municipalities in the Treasury, they pay their bond payments, and then they pay you back the principal. So it turns out that the valuations are going to be very, very predictable with regard to bonds. And this is why bonds are boring, right? So here's an example. Exelon Corporation. Who are they? It's actually a multi-state utility. They're the largest producer of nuclear energy in the country, and based in Chicago. So they have a bond. Believe it or not, it's callable. I'm surprised they haven't called it away. It's due in, that's supposed to be 2032. My apologies, I'll fix that. It's due in 10 years. Price to yield 4.101. So it's a premium bond. Interest rates have come down, right? Bond prices go up. The current yield is 5.917%, rated triple B. So they're not quite junk status, but they're right at the bottom of investment grade. If they go down to BB, then they're junk. So because the tables go at 1, 2, 3, 4, 5, 6% integers, we chose this one because 4.101 is close to 4%. So we'll use 4% for 10 years. So what's the bond price? What's the expected bond price, the predicted bond price? We take the present value of the interest income plus the present value of the repayment. Now, if you remember our calculations from chapter 4, we would go year number 1, year number 2, year number 3, and so forth. Well, with stocks, we only dared to go out 3, 4, maybe 5 years. Yeah. Well, with bonds, we got to go out 10, 20, 30 years. So with that in mind, do you really want to do 30 calculations? Year 1, 2, 3, 4. No, that's why we have a new present value table. So let's go take a look at the new present value table. It actually has 2 parts. The part on the right is the one from chapter 4, the present value of a lump sum investment. So that's the one from chapter 4 that we used for year 1, year 2, year 3. But this one over here that we're adding makes life a whole lot easier. Why? Because this is a present value of a stream of payments. We know we're going to get a certain interest payment for 10 years at 4%. And it's a 7.6% bond. So we're going to get $76. Well, actually, you get $38 twice a year, but that makes it a little trickier. So let's just use $76 every year for 10 years. And we're priced to yield. We use not what it's paying 7.6%. But we use what it's priced to yield. So 4%, it's priced to yield, well, 4.101. And down 10 years, and that present value multiplier is 8.111. So we go over, back to the presentation, we see we took the annual payment of $76 times the present value multiplier for a stream of income, a series of payments. They all mean the same thing. I like the idea of a stream. It reminds me of a river, flowing. So that $76 that we're going to get for the next 10 years every year is $760. But it's not worth $760 today. We have to discount it to the present. And I know that verb is so weird to use, discount it back to the present, but that's what they use in the industry. So get used to it. Oh, my apologies. This mouth is very, very sensitive. I keep saying I got to get a new mouse. I never do, because this one was, wireless and kind of not that cheap, not that expensive, but still. Anyway, so $76 times 8.111 tells us that that $760 that we're going to get every year for the next 10 years is worth to us today $616.43, 44 cents. Now, that's the present value of the future interest payments. What's the present value of the bond repayment? Because remember, when the bond matures, we're going to get our $1,000 back. Even though we paid more than $1,000 for this bond because it's a premium bond, we are only going to get $1,000 back. Well, that's a single payment, just like we did in Chapter 4. So we're going to go back to the table and use the table on the right, which is the same table as we had in Chapter 4. We go across to 4%, down 10 years, and it's 0.676. You see that, folks? 0.676. So we come back here and we take 1,000 times 0.676, and many of you can do that in your head. You just move the decimal point 3 to the right. And that's $676. So that $1,000 that we're going to receive in 10 years today at 4% is worth $676. You add the two together and you get $1,292.44. Well, the quoted price on April 2nd was $1,284.37. So pretty darn close to what people were paying. The bond calculator spreadsheet gives us $1,282 for annual payments, but it gives us $1,287.34 for semi-annual payments. So they're all very close to one another. Why is the semi-annual payments prediction a bit higher? Because we're getting half of the money in 6 months. We don't have to wait till the end of the year. So it's basically worth more to us. So if we go take a look at the spreadsheet on the website, where is it? There it is. There's the spreadsheet. Bond spreadsheet calculator. And there's a little video and a discussion about this. You know that, right? Up, can barely see it. Oh my goodness. Let's make this bigger. Okay, there we go. What we do, that's too big. What we do is we put in the information in the gray area. We put in the name of the company, the coupon rate, the quote. And again, free quotes are hard to find. FINRA gives them free quotes, but I don't often trust them. The day that it matures, notice it matures in 2032, not 2022. My apologies. And then the computer figures out what the years to maturity is. We put in the price to yield, the principal, and the rating, and whether it's callable or not. And then the computer calculates it. Now notice it's notice that it's gone down a little bit, hasn't it? Or has it gone up a little bit? Because we did this on April 2nd, and it's what, April 8th today? So it's gone down a little bit, or is it going up a little bit? Yeah, it's gone down a little bit because it's getting closer to the value, the time when the before. If you look at the presentation I did for this, it'll say 9.999 as it gets closer, right? So as it gets closer, the price is going to come down because it's a premium. As if it were a discount bond, as it gets closer, the price is going to go up because it's closer to the maturity date. So the spreadsheet makes life a whole lot easier. So now in the face-to-face class, this is when we would stop and do the worksheets for the Chapter 9 for the bond valuation. The trickiest part is just using the right table, right? Use the one on the left for the interest, use the one on the right for the principal payment, and making sure you use the price to yield value, not the coupon yield. Don't use the coupon, the nominal rate. If we had used 7.6%, we would get a bond that's basically selling for $1,000 because it would be selling at par. If it were a nominal yield of 7.6%, price to yield 7.6%, the bond would be selling at $1,000 because that means interest rates have not changed. So just be careful. That's the hardest part about these. But once you do a couple, you go, oh, this is easy. I can do it. Okay? So yes, even though we get to use the discounted cash flow model for bonds, we find that bonds really are boring. Oh well, they're supposed to be. Do you want to eat well or do you want to sleep well? Slide number 33. Now let's take a look at a couple of more subtle characteristics about bonds that most people just don't think about, and unfortunately because they're important. And that's the idea of, and we've already touched on this, reinvestment risk. Huh? Well, reinvestment risk is the uncertainty about the future value of an investor's bond investments that result from the need to reinvest the bond interest payments and redemptions at yields that are not known in advance. Now, this is a fancy way of saying what's going to happen in the future. Well, we don't know, right? But we do know that we're going to get our interest payments and we're going to get our principal payments. I mean, assuming the world doesn't end for these bonds, the bankruptcy or whatever. So what's going to happen is interest rates are going to change as time goes on. And we've learned that if interest rates fall, bond prices rise, and if interest rates rise, bond prices fall. So people usually get that, especially after they see the value of their bonds go down when interest rates rose, and they said, "Why? I thought bonds were safe." Well, they go up and down like stocks, nowhere near as much as stocks. But changing interest rates don't only affect the price of your bonds. They also affect your future income as you need to reinvest the interest income and bond repayments. If interest rates have fallen, although bond prices will have risen, your income level will fall as you reinvest your income and bond repayments with bonds that are now paying less than your bond paid. Likewise, if interest rates have risen, oh, my bond price fell. Although your bond prices will have fallen, your future income level will rise from reinvesting in higher paying bonds. So this is yet another example of why it is important to keep a long-term perspective. Sure, hey, my bond price went up, interest rates fell. Uh-oh, now I got to buy new bonds paying lower interest. Oh, my bond went down because interest rates rose. Shh, relax. With your payments that you're getting from the existing bonds, you're going to be able to buy new bonds that are paying a higher interest. So again, keep a long-term perspective, don't panic, and if the world ends, it doesn't matter where your money is. Duration. Now we get into things that most people really, unless you wind up in some mutual fund or pension fund working with bonds, millions of dollars. Duration is a measure of a bond price's sensitivity to changes in interest rates and bond yields. This captures both the price and the reinvestment risk. It's used to indicate how a bond will react in different interest rate environments. The duration of a bond changes as it approaches its maturity date and current interest rates change. In general, the longer a bond's maturity, the longer its duration. The higher a bond's nominal rate and yield to maturity, the shorter its duration. So the shorter the duration, the less potential price volatility, and vice versa. So this is important for mutual fund managers that may have a short-term bond fund or a long-term or intermediate-term bond fund. But for most of us grunts who maybe buy some treasury bonds at treasurydirect.gov but aren't going to be buying $25,000, $50,000 a pop for muni bonds or corporate bonds, it's not that important. And it gets kind of silly right here, like on slide 35. Duration and immunization. What is it, a virus? No. Investors who have a specified time horizon can use bond immunization to increase the probability of successfully achieving their desired goal. You keep the average duration of your bond investments equal to your time horizon, 5 years, 7 years, 10 years. You would then thus be more protected against interest rate induced price swings. Well, the problem with this is it requires constant rebalancing of your bond portfolio since durations of bonds change as interest rates change and the bonds get closer to maturity. So, again, it's mostly used by pension funds, bond fund managers, insurance companies, because they have large bond portfolios. Most of us don't have millions of dollars tied up in bonds and want to be buying and selling bonds throughout our career. It's just not something that most of us working grunts are going to do. But if you ever do wind up working at a pension fund or a bond mutual fund, remember this, okay? Well, you'll have learned it over and over again before that. So let's take a look at the three major bond investment strategies. The income strategy is the one that most people use. They purchase the bonds because they want the interest income, and especially in somebody in retirement wants the income to live off of. They're not interested in capital gains. But when individuals are wanting to be opportunistic, or sometimes you'll hear them use the word tactical, speculative, which we know means gambling, you buy bonds with the idea, speculating that interest rates will fall, especially junk bonds, rising in credit quality and price, right? That is obviously very difficult. There are people who are paid tremendous sums of money to incorrectly predict where interest rates will go. And then the combination of the two is called total return. You purchase bonds both for the income and the possibility of capital gains. Now, obviously, the income strategy is the easiest, the capital gain strategy is the hardest, and total return is somewhere in between. And you will often see mutual funds labeled total return bond fund. So what they're telling you, I don't know most people know this, what they're telling you is, we're going to do more than just buy our bonds for income. We're going to do our best to create capital gains. Now, whether they do it or not, that's up to, well, that's up to the marketplace and how well they perform. One of the most famous bonds was the PIMCO Total Return Bond, run by a gentleman by the name of Bill Gross. And he and PIMCO kind of fell out of favor with one another. And now he's working at Janus, I think, Henderson, Janison. But he's a very, very smart guy. And he's very outspoken, by the way. He was one of the few people in the industry that criticized the Iraq War back in 2002, 2003. And people were angry at him. And of course, it turned out he was right. So do look up Bill Gross, the bond guru, and you can watch some interviews with him. He's a very sharp guy. So bond laddering. What's this? Well, this is an investment strategy that is basically a diversification strategy. You buy bonds with staggering maturities, some short-term, 2-3 years, some 5-7 years, 10, 20, 30 years. And this is a very popular strategy with pension funds and bond mutual fund managers because they have considerable sums of money. What's the advantage? You're diversified. What's the disadvantage? Well, it means you have a pretty big bond portfolio, which most of us don't have. And so here is an example as of October 2021. And why I included this is to show you just how dramatic some of the changes have been. Notice that the short-term interest rates were basically zero. 2-year, 10-year, 1.5% for the 10-year. And then you finally got up to something semi-respectable with the 30-year corporate bond at 4%. But now let's fast forward almost 6 months to April 1st, and you see the 3-month, the 6-month now paying, well, still not that much, but a whole lot more than they were, almost zero just 5-6 months ago. And now we see the 5-year treasury, the 10-year treasury, and this is when it was inverted. You see the 2.59 and the 2.39 on the 10-year treasury. Now the 10-year treasury, I think, has gone above the 5-year treasury. So it's a very, very choppy time. So you think long term. But now we start to see some bond yields that would make people stand up and sit up and say, well, maybe I'm ready to put some bonds into my portfolio. At least yours truly is thinking. And considering that I'm a whole lot older than most of you folks, I should have a whole lot more bonds than I do, but I just looked around and said, the bonds are not a very good alternative right now. I'd rather have dividend paying stocks. But now we're seeing some bond yields that would be, in my humble opinion, of course, everyone's different. That's why they have chocolate, vanilla, and some people like strawberry, would be worthwhile to own in a prudent, long-term oriented investment portfolio. That sounds like an advertisement, huh? Okay, so you are going to do this. You're going to go check out the bond spreads. You know, the difference between the corporate and treasuries and municipals and treasuries, and take a look at the yield curve and the yields that are being paid right now. And you'll probably see that they're a little higher than they were here on April 1st by now. So very cool. Dear students, that is our discussion of bonds. We've gone through the introduction to bonds, talked about different bond types, characteristics of bonds, and then we've looked at how to calculate the yields, current yield, yield to maturity, yield to call, the taxable equivalent yield, looked at the yield spreads and the yield curve, and then learned how to use the discounted cash flow model with bonds. Oh well, I know it's not as exciting as stocks, but they're an alternative. Now, in our next chapter, we're going to burn through hybrid securities. Why? Because they're really not that popular. There's not that many of them. And for the most part, people who are just retail investors are not that interested. And we'll see why later on. And then, after chapter 10, we're going to go back to the very beginning of the semester. Back to the very beginning and tie it all together. Very cool. I think so. So think of how far you've come. You should be very, very proud of yourselves. We are very proud of you. You are official investment gurus and can speak with authority to your friends, family, and colleagues. You are awesome. See you in our next chapter on hybrid securities, preferred stocks, and convertible bonds, convertible preferred stocks, convertible securities.